Today, we are diving into Phillips 66's latest earnings, and boy, is it a head-scratcher. The stock jumped over 4% after missing revenue by a whopping $2 billion. So what in the world is going on? Let's dig in and figure it out.
All right, here's how we're going to break this down. First, we'll lay out this whole beat-miss rally puzzle. Then we'll get into the numbers. After that, we'll talk about management's big plan, what they're saying about the future, and then, you know it, we'll give you our take on the whole thing.
All right, section 1. Let's get right into this puzzle. I mean, on the surface, the Phillips 66 report looked like a total mixed bag. The numbers just didn't seem to add up. So check this out. This is the heart of the confusion. Revenue? A huge miss. We're talking $2 billion short of what everyone was expecting. Ouch. But then you look at adjusted earnings per share, and it's a solid beat. They came in 22 cents higher than predicted. So what gives? You've got this big miss on sales, but a nice beat on profit. So how did Wall Street react? You'd think maybe it'd be a flat day, right? Wrong. The stock rallied. I mean, it shot up over 4% in one day. That's a really strong signal from the market. And that is the big question we're here to answer. Why on earth did a $2 billion revenue miss lead to a rally? Clearly, investors were looking at something else, something way more important than just that top-line number. So to solve this thing, we've got to do what any good analyst does. Ignore the headlines and dig into the numbers. This is where the real story is. And the answer, my friends, comes down to one word: cash. Just look at this. Phillips 66 was an absolute cash machine, pulling in $2.75 billion from its operations. And what did they do with it? They were super disciplined, only spent about $680 million on new projects. And then, get this, they handed over $760 million right back to shareholders through dividends and buybacks. Wall Street absolutely loves to see that.
And it wasn't just the cash flow. The whole picture looked great. Their balance sheet, rock solid, with a net debt-to-capital ratio of just 38%. And operationally, man, they were firing on all cylinders. Record performance in both refining and their midstream business. And the proof is in the pudding, right? Look at the stock's one-year return, over 28%. Meanwhile, the rest of the energy sector was actually down. They're just crushing it.
Okay, so the numbers under the hood were fantastic. But believe it or not, that's only half the story. The other half is how management sold it. They didn't just report numbers. They told a story about a huge strategic shift for the company.
And the CEO, Mark Laser, he was crystal clear about it. He called 2025 a pivotal year. He basically said, look, everything we've been working on for years, it's finally starting to pay off. He was selling this as a massive turning point, not just another good quarter. So what is this big plan? Well, it's pretty straightforward. It boils down to three things. 1, simplify. Sell off the stuff that isn't essential. 2, get efficient. Cut costs like there's no tomorrow. And 3, grow the midstream business. That's where the steady, high-margin money is.
And the key to that growth plan is this concept they keep talking about, the wellhead-to-market machine. It sounds a little jargony, but the idea is simple. They want to build a system that controls everything from the moment the product leaves the ground to when it gets to the market. This makes them way less vulnerable to the wild swings you see in the refining business. It's all about creating a more stable, predictable business. And here's the kicker. They put a number on it, a big one. They told the street they're targeting $4.5 billion in adjusted EBITDA from midstream by the end of 2027. That's huge. It's specific, it's ambitious, and it's exactly the kind of thing that makes investors sit up and pay attention. So that's the big picture story they're telling. Now let's see how they backed it up. We're going to look at their guidance for the future and how they handled some tough questions from the pros. And, you know, the analyst Q&A is always where the rubber meets the road. Steve Richardson from Evercore ISI asked a great question. He basically said, okay, great story, but what about costs? And he's right to ask, because in a business like this, cost control is absolutely everything. And management's answer was just masterful. They were so prepared. They said, yeah, the headline number was $5.96 a barrel. But hold on, if you adjust for this one-time refinery issue, we're already at $5.57. Then they laid out exactly how they're going to get that number down even further to around $5.50. It was clear, it was data-driven, and that's the kind of thing that gives investors real confidence. Their official guidance for the next quarter really hammered home this theme of discipline. They're planning to run their plants at really high capacity. We're talking low to mid-90s. And they gave super clear numbers on expenses. They basically handed analysts everything they needed to plug into their spreadsheets and say, wow, this looks good. All right, let's bring it all home. In our last section, the next call, we're going to finally solve that puzzle from the beginning and tell you what we think happens next. So let's go back to that original question. Why did the stock rally on a revenue miss? The answer's pretty simple, actually. Investors completely ignored the headline. They looked past the noise and saw what really mattered: a fire hose of cash and a believable plan to turn this company into a steady, reliable moneymaker for years to come. So, given how well they're executing, the clarity of their strategy, and how much the market loved it, our official rating here is outperform. We think this momentum is the real deal, and it's got legs. So how do you play this? For us, the idea is to be long the stock. Why? Because we think the market still isn't giving them enough credit for this transformation. They're changing from a classic, volatile refiner into something much more valuable, a steady cash compounder. The thing to watch for, the catalyst, will be in the next couple of earnings calls. Do they keep hitting those midstream goals? Do they keep driving down costs? If they do, this stock has more room to run. And of course, we always have to say it, this is just our analysis for informational purposes. It is not financial advice. Please do your own research.